Well, the S&P 500 has spiraled in recent days, with the benchmark index shedding about 3% since the Federal Reserve warned of its higher for longer stance. But the sell-off isn't necessarily a buying opportunity, according to some on Wall Street. Yahoo Finance's Josh Schaefer is here with that story. Hey, Josh, what are the bears saying out there?
Yeah, Brad. So we've been taking a pulse of the bears and the bulls here, right, and seeing who's maybe finding a buying opportunity in this dip that we've seen and who is not. So J.P. Morgan's Marko Kolanovic has had a 4,200 target call on the S&P 500 for some time now. He's not moving off that call, and if anything, probably sees a move to the downside over a move to the upside. That's largely for some obvious reasons we've seen when you take a look at that 10-year that's up about 50 basis points over the last month, and then you look at oil coming up nearly 15% over the last month as well. We know those are key, obvious headwinds. But then he also highlights an interesting thing here overall. He says that the core risk for markets and the economy remains interest rate shocks. And Kolanovic sort of gets into a comparison to 2008, how interest rate shocks worked then in 2008 and 2007 and 2008, and says, of course, this time is different. We're not necessarily talking about subprime mortgages, but he said that it rhymes with 2008. And he takes a look at consumer delinquencies that we're seeing on certain loans. So if we take a look at that chart from J.P. Morgan, you can see consumer delinquencies on consumer loans picking up significantly. You're seeing there are loan or delinquencies for credit cards, delinquencies for auto loans. Look at bankruptcies, up significantly, all rising as that Fed funds rate comes up. And so when we're talking about that lagging impact that Kolanovic sees, you had a lot of companies that borrowed at pretty cheap prices, pretty cheap loans, right? Not a lot of interest on those loans. Of course, as they come back to market over the last year, in the next year, they're going to have to pay a lot more to borrow money. As they pay more to borrow money, we're going to see more people defaulting, whether that be consumers or corporates. So they're sticking with the stance here that we're still going to see a slowdown, and this is not necessarily going to be, a short bounce and a short drop and then a bounce back up. At least not for now.
Josh, you're plugged into markets. Of course, manning that one of my favorite things on Yahoo Finance, that is our live markets blog. As you talk to people in markets and you consume a lot of these notes, is Marko's view on markets, is that the outlier, or is that just the vibe on Wall Street as we look towards the rest of October?
Yes, Oz, it seems like it can really go both ways, right? Which I know is sort of me taking the middle ground, and you can always say that. But I just spoke with Liz Young, the head of strategy over at SoFi, about an hour ago, and she's sort of in Marko's camp. She said, the sell-off over the last week was warranted, but I'd like to see more. I think these valuations are still too high. The S&P 500, the overall PE there is just simply too high and needs to fall below 18 likely, which would be a leg down for the S&P. But then you talk to some other folks, and they see potential for this to just continue, for the S&P to pick back up. If you look at, say, Tom Lee at Fundstrat, who's normally known as one of the more bullish strategists on Wall Street, right now, Fundstrat sees things going higher because of why the Fed is threatening to keep interest rates high, right? When we think about interest rates being high and sort of what Jerome Powell said last week, the bull take is, well, if interest rates are high because the economy is going to keep doing well, overall, that should be good for earnings. GDP growth would, in theory, be good for earnings. So you can see both sides here sort of playing out over the next month. There aren't too many people that look at an auto strike, a looming government shutdown, and the potential for another interest rate hike in November, SAWS, as a positive for equities, at least in the next month. But luckily, we'll have some more time to see how it plays out.
Josh Schaefer, good stuff as always. Appreciate it.